Property valuation principles maximize profits for accurate property valuation. Presentation overview comparative analysis. Comparative analysis is a method for evaluating a property by comparing it to similar properties that have been recently sold or leased in the same market. It is a simple and straightforward method, but it may not always be accurate due to differences in properties and market conditions. Discounted cash flows. Discounted cash flows is a method for valuating a property by estimating its future cash flows and discounting them to their present value. It is a more complex method but can provide more accurate results. However, it is highly dependent on the accuracy of the assumptions made. Direct capitalization. Direct capitalization is a method for valuating a property by using a capitalization rate to convert its net operating income into an estimated value. It is a quick and easy method, but may not be accurate in all market conditions. In conclusion, the three primary principles for evaluating a property are comparative analysis, discounted cash flows, and direct capitalization. Each method has its own strengths and weaknesses, and the choice of method depends on the property type, market conditions, and availability of data. Comparative market analysis (COMS). What is a COMS analysis? COMS analysis compares the subject property to similar properties in the same area that have recently been sold or are currently on the market. This helps to determine an accurate price range for the property. How does a COMS analysis work? A COMS analysis involves collecting data on similar properties in the same area that have recently been sold or are currently on the market. This data is used to determine an accurate price range for the subject property. Advantages of using COMS analysis. A COMS analysis is a quick and easy way to determine the value of a property. It is also a reliable method that takes into account the current market trends and other external factors that may affect the value of the property. Disadvantages of using COMS analysis. A COMS analysis may not take into account unique or unusual features of the property that may affect its value. It also relies heavily on the accuracy of the data collected and may not be a suitable method for evaluating non-standard properties. What is a comparative market analysis? Comparative market analysis is a valuation tool that compares the value of a property by analyzing the prices of similar recently sold properties in the same market. It is a useful tool for determining the fair market value of a property. How to conduct a comparative market analysis. Comparable properties. Comparative market analysis requires the appraiser to look at recently sold properties in the same area that are similar in size, features, and condition to the property being valued. Adjustment of sale prices. After selecting comparable properties, the appraiser will adjust the sale prices of these properties to account for any differences between them and the property being valued. Discounted cash flows, DCF. What is DCF? DCF is a method of valuing a property by estimating its future cash flows and discounting them back to their present value. How does it work? DCF works by estimating future cash flows and discounting them back to their present value using a discount rate, usually the property's cost of capital or weighted average cost of capital. Advantages of DCF. DCF takes into account the time value of money, making it a more accurate method for valuing a property. It also allows for flexibility in adjusting assumptions and factors to reflect changes in the market. Disadvantages of DCF. DCF requires a lot of estimations and assumptions, which can be complex and time consuming. It is also highly dependent on the quality and accuracy of the data used, which can be difficult to obtain. What are discounted cash flows? Discounted cash flows is a method of valuating a property by estimating the future cash flows that the property is expected to generate and discounting them back to their present value. How to calculate discounted cash flows. Estimate future cash flows. Real estate appraisers estimate expected future cash flows the property is expected to generate based on various factors such as rent, occupancy rate, maintenance expenses, and taxes. Adjust for inflation. Cash flows are adjusted for inflation in order to account for the decrease in purchasing power of money over time. Discount for time value of money. Cash flows are discounted back to their present value using a discount rate that accounts for the time value of money. The higher the discount rate, the lower the present value of the cash flows. Adjust for risks. The discount rate also accounts for the risks associated with the investment, such as market fluctuations, inflation, and potential changes to the property itself. Direct capitalization. What is direct capitalization? Direct capitalization is a real estate valuation method that estimates the value of a property based on its net operating income and the capitalization rate of similar properties in the area. How direct capitalization works. Direct capitalization works by dividing a property's NOI, net operating income, by the capitalization rate to arrive at an estimated value. Advantages of direct capitalization. The advantages of using direct capitalization include simplicity, speed, and cost effectiveness. Disadvantages of direct capitalization. Disadvantages of using direct capitalization include its reliance on accurate data, the need for comparable properties, and its limitation in accounting for unique properties. What is direct capitalization? Direct capitalization is the process of valuing a property based on the expected net operating income it generates. It is commonly used in income producing properties. How to use direct capitalization. Estimate net operating income. To use direct capitalization, a real estate appraiser will estimate the net operating income that the property is expected to generate. Subtract operating expenses. After estimating the net operating income, the real estate appraiser will subtract any operating expenses to determine the property's net operating income. Apply capitalization rate. Once the net operating income and operating expenses have been calculated, the real estate appraiser will apply a capitalization rate to determine the property's value. Conclusion. Comparative analysis, discounted cash flows, and direct capitalization are the primary techniques used for evaluating a property. These methods provide valuable tools for calculating the fair market value of a property. Thank you.